This is the beginning of part 2 of our module on asset liability management, which analyzes the impact of interest rate shifts on a financial institution's net interest income and net worth. We remind you that this part 2 contains 2 chapters. Chapter 3, which describes the guidelines of the Basle Committee for the measurement and management of interest rate risk in the banking book, and Chapter 4, which contains the quiz. This Chapter 3 reviews the guidelines of the Basle Committee for the measurement and management of interest rate risk in the banking book, and especially the committee's standardized model for the measurement of this risk. Basel permits banks to implement an internally designed interest rate risk model centered on either of the repricing or the duration approaches presented in the previous chapters, subject as usual to minimum standards and regulatory audits. Alternatively, the standardized model is available for smaller institutions lacking the know-how, systems, data, and personnel to design their own internal model. We summarize the mechanics of this standardized model using our previous example of a simplified balance sheet. More details on the principles for the management and supervision of interest rate risk, as generally set by the Basel Committee, can be found at this link here. The following principles govern the standardized model. All assets and liabilities in the banking book and all off-balance sheet items in the banking book that are sensitive to changes in interest rates, including all interest rate derivatives, are slotted into a ladder structure comprising a number of time bands designed to reflect meaningfully the nature of interest rate risk within each national banking market. Separate maturity ladders are used for each currency accounting for more than 5% of either banking book assets or liabilities. On-balance sheet items are recorded at book value. Fixed rate instruments are slotted into the maturity ladder according to their residual term to maturity. Floating rate instruments according to the remaining time to their next repricing date. Exposures that create practical processing problems because of their large number and relatively small individual amounts, such as installment or mortgage loans, may be slotted on the basis of statistically supported assessment methods. Core deposits are slotted according to an assumed maturity not longer than 5 years. National supervisors are to provide guidance on how items with behavioral maturity or repricing that differs from contractual maturity or repricing terms are slotted into the time band structure, including demand deposits and savings accounts. Derivatives are deconstructed into positions in the relevant underlyings. Futures and forward contracts, including forward rate agreements, FRAs, are treated as long-short combinations in the manner described in previous chapters. Swaps are deconstructed into long-short notional positions, again in the manner described in previous chapters. The separate legs of cross-currency swaps are slotted into the relevant maturity ladder for each of the relevant currencies. Finally, options are considered according to the delta equivalent amount of the underlying or of the notional underlying. The calculation process consists of 5 steps. Step 1, we offset longs and shorts in each time band, resulting in a single short or long position for that band. Step 2, we weight these resulting short or long positions by a factor designed to reflect the sensitivity of each position in each time band to an assumed yield curve shift. The weighting factors for the various time bands are listed in worksheet BIS, Simple BS, which we will use in just a moment. These factors are derived from assumed parallel shifts of 200 basis points across the curve, combined with a proxy for the modified duration of positions situated at the midpoint of each time band and assumed to yield 5% currently. Step 3, we sum these resulting weighted positions, offsetting longs and shorts, leading to the net short or long weighted position for the banking book in the currency in question. Step 4, we calculate the weighted position of the entire banking book by summing the net short and long weighted positions calculated for different currencies. Finally, step 5, we relate the weighted position of the entire banking book to capital. Note importantly that Basel does not yet impose any particular quantitative limit on this ratio. The standardized model serves really as a roadmap for national supervisors to assist them monitor banking book interest rate risk, and leaves it to them to determine whether to impose quantitative tests or limits. In this worksheet, BIS Simple BS, we apply the standardized model to our simplified balance sheet from earlier. 2 derivative instruments have been added to make the illustration more comprehensive. A 5-year interest rate swap with notional of $100 million, under which the bank pays 6-month LIBOR and receives fixed at 4.395%, and a 2-year collar on 6-month LIBOR with a notional of $80 million, consisting of a cap at 4.25% and a floor at 3.2%. We also calculate the deltas for each individual caplet and for each individual floorlet in these cells here. Details on these calculations of delta appear in the next worksheet, collar pricing, which we will not be going through. Towards the right, starting in cell J3, we list the inputs specified in the standardized model, namely the time bands and the weighting factors, based on the assumed 2% parallel shift across the curve and the proxy for modified duration we described earlier. Assets and liabilities are slotted in the 2 tables underneath. Assets appear in this table beginning in J21, and liabilities in this table here beginning J38. The remaining process is simple and very similar to the examples we showed in the gap analysis section. But please click pause and make sure you are comfortable with all content. The last table at the bottom that contains the maturity ladder for derivatives, beginning on this cell J55, needs some explanation, however. The 5-year IRS position is treated in the same manner as in the gap analysis of the repricing model. The bank is paying 6-month LIBOR and receiving fixed, so the swap is deconstructed into a long 5-year zero coupon bond and short 6-month zero coupon bond, each with a face value equal to the IRS notional. For the color, we remind you first that caplets and floorlets are slotted according to the delta equivalent amount of the underlying. The underlying for each caplet or floorlet is the LIBOR forward that sets at the beginning of the relevant period and settles at the end of that period, which is itself treated as a long-short position. A caplet becoming a long zero coupon bond maturing on the reset date and a short zero coupon bond maturing on the settlement date, and a floorlet becoming a short zero coupon bond maturing on the reset date and a long zero coupon bond maturing on the settlement date. The notional bond's face value in each case is the notional amount of the collar. We therefore slot each caplet in the maturity ladder as a long zero coupon bond maturing at the beginning of the relevant interest period and a short zero coupon bond maturing at the end of that period, in each case with a notional equal to the collar's notional multiplied by the delta of the caplet. For example, the 1-year caplet becomes a long 6-month bond with face value equal to the delta multiplied by the collar's notional, and a short 12-month bond with the same face value. By the same token, each floorlet is included as a short zero coupon bond maturing at the beginning of the relevant period and a long zero coupon bond maturing at the end of this period, in each case with a notional equal to the collar's notional multiplied by the absolute value of the floorlet delta. We use the absolute value since we have already accounted for the fact that we are short the underlying LIBOR forward. Under the collar, the bank is long the cap and short the floor, so in aggregate, the relevant floorlets are slotted into the maturity ladder as long a zero coupon bond maturing at the beginning of the period and with face value equal to the absolute value of delta multiplied by the collar's notional, and short a zero coupon bond with the same characteristics but maturing at the end of the period. For example, for the 1-year floorlet, we show in cell P59 the long 6-month bond position with face value equal to the absolute value of delta multiplied by the collar notional. And in cell P60, we show the short 12-month bond position with the same characteristics. We now return to our first table at the top, where we show the aggregated position for each time band in cells 04 to 016. You should have no difficulty confirming that each amount is simply the sum of the assets minus liabilities plus derivatives slotted previously in the related time band. In the column toward the right, we have multiplied the aggregated position in each time band by the weighting factor specified in cells N4 to N16. The net weighted position of the banking book appears in cell P17 as the sum of the individual weighted positions from each time band. And finally, we translate this position into a percentage of bank capital in cell P18. You have undoubtedly noticed that the standardized method is quite similar to the duration model, since both attempt to quantify the impact of yield curve shifts on the bank's net worth. We confirm this similarity via a simple test. If we set the colors notional in the cell D25 to 0, and if we increase the IRS notional in cell D22 to 120 million, we find that the impact of rate shifts becomes close to 0. As you can see in cell P18. A result reasonably in line with the 104 million notional for the 5-year IRS that permitted us to immunize the bank's equity to yield curve shifts using the duration model back in Chapter 2. Of course, we would not have expected these two figures for swap notionals, the 120 million here and the 104 million from Chapter 2, to match exactly, given the substantial number of shortcuts taken by the standardized model in the interest of simplicity. We conclude this chapter with a quick discussion of the simulation approaches increasingly used by financial institutions that handle sophisticated financial instruments with complex risk profiles. The key concepts behind these approaches are similar to those under the models we have described in this module, but rely more on advanced simulation techniques such as Monte Carlo simulation to take account of a larger universe of yield curve shifts, including non-parallel shifts, and applying finer breakdowns to the various categories of on and off balance sheet assets. This includes simulating a variety of scenarios for deposit runoffs and prepayment options, and also projecting approved business plans and marketing strategies to evaluate dynamically their balance sheet impact under a variety of interest rate scenarios. This completes this chapter 3 and brings us to the final quiz.